right. So you want to understand the key takeaways from this book, The Intelligent Investor by Benjamin Graham.
Yeah.
Now, this book
It's
kind of
plenty.
considered the Bible
Yeah.
of value investing. And in this deep dive, we're going to unpack some of the core concepts and really try to give you some actionable insights that you can take away and use on your own investment journey.
Yeah, absolutely. I think it's
Got it.
a great book, and it's really stood the test of time. And Graham's philosophy is really as relevant today as it was back then.
So let's just jump right into it.
Okay.
First of all,
Yeah.
what does Graham actually mean
Right.
by value investing?
Yeah, so when we talk about value investing, we're really talking about trying to find companies whose intrinsic value or their true worth is significantly higher than what the stock price is
Right.
reflective.
So it's kind of like going to a flea market.
Yeah, exactly.
And you see something that's way more valuable than what the sticker price is.
Yeah. Exactly. You're looking for those hidden gems where the market isn't fully appreciating the true value of the company. And that's where that concept of buying a dollar for 50 cents comes into play.
Right.
So that difference between the 50 cents that you're paying and the dollar's actual value, that's your margin of safety.
Okay, hold on.
Yeah.
This margin of safety,
Yeah.
I think we need to dive into that a little bit more.
Yeah, absolutely. So the margin of safety is that buffer that helps protect you from potential losses and from Mr. Market's mood swings.
Okay, so now we're talking about Mr. Market.
Right.
Who is this Mr. Market?
So Graham uses this really brilliant personification of the stock market as Mr. Market. He kind of portrays him as this manic, depressive guy who comes up to you every day and offers to buy or sell stocks from you.
Okay.
And sometimes his prices are reasonable, but oftentimes he's driven by fear and greed, and he's not really looking at the fundamentals of the businesses.
So basically what you're saying is we shouldn't necessarily panic
Exactly.
when the market is down, but maybe look at it as a buying opportunity.
Yeah, you want to look at it as a potential opportunity because when Mr. Market gets really fearful, that's when you can find some of the best bargains.
It's like when a store is having a clearance sale.
Exactly.
Everything's marked down, and it's a good time to go in and find some deals.
Yeah. So you want to be greedy when others are fearful and fearful when others are greedy. That's kind of the mantra of value investing.
So how do we figure out this intrinsic value?
Yeah, that's a great question. So it's not always easy, but it involves really delving into the company's financial statements, looking at things like their earnings, their assets, their debt, and trying to understand how much cash they can generate in the future.
It sounds complicated.
It can be a little bit complex, but there are some key ratios and metrics that you can look at. For example, the price to earnings ratio, the price to book ratio. These can give you a sense of whether a company is undervalued relative to its earnings or its assets.
Okay, so those are the fundamentals.
Yeah, those are some of the key fundamentals, and there are other qualitative factors that you can look at as well, like the quality of management, the company's competitive advantage, and their long-term growth prospects.
Okay, so I'm starting to get this a little bit.
Good.
So we talked about margin of safety. Can you give me a real-world example of what a margin of safety might look like?
Sure. So let's say you're looking at a company and you determine through your analysis that its intrinsic value is $100 per share. But Mr. Market, in one of his moods, is only offering to sell it to you for $50 per share. Well, that $50 difference between what you're paying and what you believe the company is worth, that's your margin of safety.
I see.
The bigger that margin of safety, the more room you have for error in your analysis and the less risk you're taking on.
So bigger is better.
Generally speaking, yes.
I got it.
Yeah.
So how do we actually put all this into practice? What's something our listeners can do today to start thinking like a value investor?
Well, I think the first thing is to really start tuning out the noise and focus on the fundamentals of the businesses that you're interested in. Don't get caught up in the hype or the short-term fluctuations of the market. Really try to understand the underlying value of the company.
Got it.
And then secondly, remember Mr. Market. He's always going to be there trying to tempt you with his emotional swings.
Right.
But you have to be disciplined and stick to your analysis.
Don't let your emotions make your decisions for you.
Exactly. And finally, always consider your margin of safety. That's your protection against the unexpected.
Okay, so it sounds like a lot of this is about finding those hidden gems
Right.
that the market is undervaluing, buying them at a discount, holding on to them for the long term, and not really getting caught up.
Yeah, exactly. Graham was a big advocate for long-term investing. He believed that over time, the market would eventually recognize the true value of a company.
It's interesting because if you look at someone like Warren Buffett,
Yes.
he's a prime example of somebody who built his fortune using Graham's principles.
Absolutely. Warren Buffett was actually a student of Benjamin Graham, and he often cites Graham's teachings as the foundation for his success.
So it's something to think about.
Mm-hmm.
When you're delving deeper into the intelligent investor, in today's market, with all the technology and the complexities, how do we adapt Graham's principles to identify those companies
Yeah, it's a great question.
that are undervalued and ripe for the picking?
It's a challenge, but that's what makes it so rewarding.
Good luck investing, everybody.
Happy investment.